Now, how do we safeguard the investment? We know it has to be at risk, but like Kate mentioned, it doesn't have to necessarily be unnecessarily risky, but it does have to have some element of risk in order to qualify for the EB-5 program. So with that, Bruce, do you want to kind of walk us through a couple of these major buckets and topics that you always want to be keeping in mind as an investor is considering one project over another, and then we can get into some follow-ups on some more specific questions.
Yeah, thank you very much. So to begin with, really, what I want to do is make sure that when you're looking at the risks can go from very small. It's never going to be zero, right? There's always going to be risk in any project to a very, very high level of risk. So when looking at any project as an EB-5 investor, whether you're coming in as a lender or perhaps as a preferred equity investor, you really want to put on a hat as sort of like an underwriter at your bank. And you want to assess the risks that are inherent in the loan. And there are a lot of factors that you're going to look at when you do that, right? So this is all about making sure that the risks are measurable and that you're comfortable with them, understanding what those risks are, assessing it, and then ultimately making sure that not only are the risks comfortable for you, but also that the jobs are being created as was expressed by Kate and Sam in the prior portion of this presentation, right? So everybody needs to really put on their due diligence hat, as I said, and act as an underwriter. One of the first questions that I would look at is when looking at any project, who the developer is and what is their track record of success. Do they have a long track record of doing a lot of development and completing those developments, on time and on budget? Is this the first EB-5 project that they have ever done? And so on, right? And that's going to be an important metric for you. Additionally, you want to look at whether or not they've had failed projects. Many developers, of course, will have projects that have never failed. Some projects are going to be, it's going to be more evident that they've had struggle completing projects on time and on budget. And obviously, that's a risk that you want to weigh. Another good measure here is taking a look at the financial wherewithal of any developer. And that's where the balance sheet comes in. I would recommend that everybody looking at any project take a look at not only the balance sheet of the developer, but if there's a guarantee involved, the balance sheet of the guarantor, because you want to make sure that they have the wherewithal to go through this project, and should something happen, that they can support the project and help get this project to a successful ending and the creation of the jobs. You can turn the slide. Additional metric that I always want to look at too, because this really impacts, I think to a large extent, whether or not the loan documents or the investor documents that you're receiving are sort of fair and balanced. And so what we look at here is whether or not the general partner is wearing more than one hat. Certainly if the general partner is involved both on controlling the NCE, as well as being an affiliate or controlling the JECE, there's going to be an automatic conflict of interest. And then the question is going to arise as to whether that developer is really incentivized to provide a fair deal, if you will, to the investor or the lender or not. So you're going to need to take a look at the loan documents very carefully, and that's where we can come in to help you, right? To make sure that they are fair and balanced, and that there are favorable protections for the investor. If the GP, as part of those loan documents, has waived its fiduciary duty, then they're basically telling you up front they're not responsible for acting on your behalf as an investor as a fiduciary. That should be a red flag to you, and you should look at those provisions very carefully and decide whether that is something that you're going to be comfortable with.
Right. I guess what I'm getting at there is, if I'm the general partner, but I'm also the borrower, and I make a loan for $30 million, and then all of a sudden the project doesn't do well, can't meet the debt service, can't pay the interest payments, or can't repay the loan, then I can modify the loan agreement, restate it, make changes that a normal lender wouldn't make, because I'm also the borrower. So I'm acting as the developer trying to make money for my project, but I'm also acting as the kind of steward of the EB-5 investor funds. And if there's no if there is that conflict and it's been waived, right, then I'm probably going to do what's better off for me as a developer, because that's where I'm going to make money, and I'm probably going to do what's worse off for the EB-5 investors.
That's correct. And that's why I'm saying there needs to be some look at the loan agreements and the covenants to see that they're fair and balanced, right? Because if I'm wearing two hats, I am likely, in the event things are not going as they should, if you will, to be wearing my general partner hat more than my, taking care of my investor hat, right? And those are serious conflicts. Now, do they often come into play? The answer is no, not all the time, but you need to assess it on a job-by-job basis.
All right, so let's shift over to capital stack. So for those of our investors, oftentimes investors are engineers, they're musicians, they're poker players, like Kate's client. They're not real estate development underwriters or investors. So kind of knowing that, what is a capital stack? What are these different components that investors really do need to familiarize themselves with before they can really make an educated decision about how their funds are going to be used in the project?
So this is really, from my perspective, one of the most critical aspects of doing your review and assessment of a project. Number one, you want to make sure that there's adequate collateral in place. And that collateral has to have some real value, because you have to assume going into this that things may not come out the way everybody wants. And so you have to assess the value of the collateral versus the risks that you're taking. EB-5 capital is only going to be one part of the capital stack that we look at in a EB-5 project. Usually see a portion of the capital stack being developer equity, another portion being a senior lender, and then the third portion usually being the EB-5 investor or lender, making up the difference, if you will, the gap in those two numbers. Many times we see projects where part of the collateral package is a guarantee. To the extent that there's a guarantee involved, as I indicated earlier, you want to dive deep into the financial status of the guarantor. You want to look at those financial statements and determine whether or not those financial statements are strong enough to stand behind the risk that you're going to be assessing. Another thing to look at here is, of course, the cost of financing, right? A senior lender is also going to be doing its own underwriting as part of this project. So to the extent a senior lender is in place, it's going to do its own risk assessment, and the terms that you're going to see from a senior lender oftentimes are going to reflect the risk that the bank thinks is involved in this particular transaction. The higher the risk, the more stringent the loan terms are going to be, and probably the higher the interest rate is going to be. So as part of your analysis, you should be looking basically over the shoulder of the senior lender and see what they did and what concerns they have to make sure that it's being properly addressed and analyzed by yourself as you look at the project.
Got it. Okay, so a few follow-up questions there. So first, just on the senior loan, separate senior lender topic, having a senior lender in place obviously is a good thing, right?
Well, I think just as you indicated, right, the senior lender is coming in as a professional. They do this for a living. They're going to assess the risk better than you as a EB-5 investor who might be an engineer or professional, or this is not necessarily your skill set, right? So the senior lender is going to go through an underwriting process. It's going to go through a loan committee. It's going to have a lot of financial analysts looking over the history of the developer, the history of the guarantor, their financial wherewithal, the risks of the project in that particular market, perhaps in that particular sector of the market. So they're going to have a lot more familiarity and depth in terms of the analysis that they're going to do, and you should take advantage of that and take a look at what their assessment has resulted in, and use that as a leverage in assessing the risk on your own. I think it's very helpful to have a senior lender in here. The senior lenders, by the way, for the most part, like when EB-5 comes in, because EB-5 is coming in underneath them. And so the senior lender might have much less risk actually than the EB-5 investor who's coming in at mezzanine level. One of the things I mentioned before that I do want to elaborate on again is the fact that when you look at the loan documents from the senior lender, they're going to tend to have some very, very tight covenants in there, both financial covenants, negative covenants, affirmative covenants. One of the things that you see in a lot of senior lender programs today is whether or not the loan to value ratio is maintained throughout the project, what the debt ratio is going to look like going forward. And as the project changes, like in the situation we are in today, where you have higher interest rates, you have inflation with construction costs, a lot of projects are getting into situations where they're out of balance with the financial metrics that are set by the bank, and the bank is coming back to the developer and saying, hey, we need more capital, more equity capital underneath our capital stack. That's something that's, I think, important for investors to take a look at in these loan programs, because if that's here, that within the senior loan document, then you need to be asking the question to the project, hey, what are you going to do? How are you dealing with this if there's going to be a gap in financing as we go forward? Because you may look like you're fully financed today, but a year or two down the road, you may not be. And what does that mean to the project and my ability to get the jobs I'm being guaranteed and of course, the completion of the project?
Yep. So definitely want to spend a few more minutes on this topic because I think this is a really, really critical point, and you've hit on a couple of the items. So, in terms of like the most kind of applicable scenario, I always like to paint a real picture of where this is going to be a problem. When you tell me that projects nearing completion maybe, but interest rates are up and it's going to be dependent on an ability to refinance in the future, that sounds like a project like a big apartment building or a big hotel maybe that was started 3 or 4 years ago. It was underwritten based on more conservative interest rate assumptions. Now maybe the project's going to be done in the next year and a half, 2 years, and now rates are much higher. What happens in that situation when the building gets done, but then the values drop because of interest rates? Like how does that situation play out for a developer, and why is it really important to look carefully at projects that are just dependent on a refinancing event very close to being completed?
So I think there's a lot to your question. Let me begin by saying that there's never no assurance. There's always going to be risk, right? There's no riskless project going into these. So I think it goes back to the first slide that we looked at, where we're talking about looking at the balance sheet of the developer and looking at the balance sheet of the guarantor, if there's one, to make sure that they have the financial wherewithal to get through, a downslide, if you will, in the market. Many of these projects with senior financing, if you get into a situation with the covenants, it is going to mean a refinance of the project. It may also mean an extension with the senior lender. The senior lender may be getting more uncomfortable and say, hey, we'll give you an extension, we'll give you a forbearance, but it's going to be at some additional extra cost. And the developer may have to go out to the marketplace outside the EB-5 investor to bring in some additional equity on its own, which I've seen in many cases and done very successfully, because as you're nearing completion of the project, there's a high risk that project's still going to be successful from an investor standpoint. The margin on the profitability of the developer might be reduced, but it's likely that if you're getting near completion, the developer is going to be able to finish that project through an alternate means of financing. And so those are just part of the analysis that I think you have to go through and get comfortable with. Did I answer your question or not?
Yeah, that's great. So just last point on the senior loan. So, just given the importance of that third-party diligence on the project, how important is it for an EB-5 investor to actually get access to and review the senior loan agreement that's in place, for the project? Is that
I think
a critical item, or?
Yeah, I think it's very important. I think it's very important to not only look at the balance sheet, right, and make sure that there's plenty of developer equity there, but also to look at the loan conditions and loan covenants of the senior lender, because that's going to give you a lot of insight as to how the senior lender is looking at this project, and that then translates into risk level, if you will, of this project being completed successfully.
Got it. Got it. So regional center sponsor, telling an investor, hey, we've got a senior loan in place, but refusing to provide it, probably not a good sign.
I don't think that's a good sign. I believe in transparency. I mean, let's walk outside of the EB-5 investment realm. Okay, if you're dealing with a second mortgage lender, or some sort of other subordinated lender using any alternative financing in any market, there's no way the deal's getting done without that subordinate mezzanine level investor looking at those senior loan documents. It's just not.
And I think that's
it doesn't happen outside EB-5. It shouldn't happen in the EB-5. It's critical.
And I think that's the key point is, yes, this is an EB-5 investment. You're doing it for the benefit of the green card, but at the end of the day, this is just an investment. It should be the same diligence, same everything as a non-EB-5 investor for this type of deal.
Exactly.
So I think that is probably the most critical thing that you can say.
That is absolutely correct.
Yep, and the same would apply not just
look under the hood.
Right, exactly. So not only the senior loan agreement itself, but also the balance sheets, the financial statements, so you can actually get an accurate picture of what's happening in the project at the time you invest.
Correct.
Right, and I know that unfortunately, it's not standard for many EB-5 projects to make available the financial statements as part of their documentation package, but that doesn't mean they don't have them or that they could share them if asked, right?
Well, they certainly have them. If they don't want to share them, that's a big red flag.
So switching gears now, we talked a little bit about the capital stack generally, but you're the expert on this, Bruce. Kind of give us the different flavors and how you see EB-5, kind of fitting in most situations today.
Sure. So the chart that you depicted here, Sam, is pretty standard in terms of how you see the sources of capital in most of the EB-5 projects today. The common equity is usually put up by the developer, and it could be a combination of cash and/or perhaps land contribution, right? Because they may already own the real estate underneath it, and they're contributing the real estate to the project, and of course that has some real value. So they usually make up we usually see between 15 and 20% of the capital stack. Then you normally have the mezzanine debt level, and that could be either and/or preferred equity from an EB-5 investor, or a loan from EB-5. And generally speaking, those two will work out to be about 35% of the capital stack, and then you might see the senior loan come in for 45 or 50% of the capital stack. Now, from a risk standpoint, what the investor has to understand is that the senior lender is senior because it's going to get paid first if there's a default on the loan. And whatever collateral exists, they're going to take grab of the hold of that collateral. They're going to pay themselves back before anybody else gets paid off. So when looking at this chart, you really look at it from a reverse standpoint. The senior lender is going to be first to get repaid, then the mezzanine debt EB-5 person will get a second bite at the apple. Then it goes to the preferred equity EB-5 investor, and then ultimately back into the developer if there's any money left over in the project upon failure of the project or foreclosure. Most of the time there won't be any equity in the deal. So when you look at the structure of the capital stack, if there is a EB-5 project that offers both preferred equity and mezzanine debt as part of their EB-5 capital program, the preferred equity usually is going to have a higher coupon, a higher interest rate, and perhaps some better terms because they're at higher risk of losing their money than the mezzanine debt EB-5 investor, if that makes sense.
Got it. Yep. So at that point, it's really just.
Here, by the way, if the developer's not putting their own money at risk next to yours, I wouldn't invest in the deal. You want them to lose their money because if their money is at risk, they're really incentivized to do everything they can to make a successful project, right? That's common sense.
Yep, exactly. And so if there is the opportunity to choose, between preferred equity, EB-5, or mezzanine debt, it's really just risk tolerance, right? If things go wrong, you're safer, but you're chasing a higher return. And so you just got to have that family conversation and just decide, what do I really want to prioritize here? Green card, getting the money back, or, chasing a little bit higher yield on the fund.
That's correct. That's correct. That's an individual
right.
decision by the investor.
Yep. Okay, we touched, I think we can skip over this. We talked about the capital stack generally. The one point I want to make on this slide is just having all the funds identified to build the project, particularly if it's a single structure, like a hotel or an apartment building, like having all those documents executed in place, money being funded, so that you at least know that the structure is going to get done. That's really critical. Especially if your money's coming in early, because if there is no senior loan that's actually in place and all the equity is actually there, then the project could get stalled, like Kate described earlier, or it could just not ever happen at all, in which case funds could get lost, no jobs created, and green card problems. So making sure the project is fully financed is critical. And obviously photos, seeing what's going on site is important, but looking at the paperwork and verifying, looking at the balance sheet, the financial statements to see, is this thing actually working, and is all the money really there, is critical.